Periods of equity market drawdown and volatility reteach us the powerful lesson of the value of diversification. In 2018, we featured in our Financial Advisor Forum a technique of combining the S&P 500 Dividend Aristocrats with S&P 500 bonds as a high-quality approach to diversification. Hello, I'm Shaun Wurzbach, leading the S&P Dow Jones Indices Financial Advisor channel, and joining me to discuss how this quality approach to diversification performed over the last quarter are Jason Giordano. He's Director of Fixed Income Indices at S&P Dow Jones Indices, and Simeon Hyman. He's Global Investment Strategist at ProShares. Well, gentlemen, thanks for joining me today.
Thanks so much.
Well, Jason, you've written about this idea of combining the two, and then you've been on the road with us in our forum program talking to advisors about this. Can you talk a little bit about the indices and how, in coming together, they provide diversification?
Yeah, sure. So we feel that not only do they provide effective diversification, but that they do it in a quality approach.
Okay.
Because they share some similar themes in that these companies that comprise these indices, they have strong balance sheets and sound fundamentals and disciplined capital management techniques. And you see that in the Aristocrats, 25 years of increasing dividends. And in the 500 bond, these companies, when we compare it to the broad investment-grade corporate bond market, they demonstrate a higher skew towards higher credit ratings.
Okay.
And what we see is when you combine these two, they have effective diversification in that they demonstrate a negative correlation.
All right.
We saw this especially in the fourth quarter of 2018, specifically in the last 6 weeks. So if we compare these two and we see the correlation that they demonstrated was a negative 0.35, you're getting that effective diversification, but you're also getting the benefit of an enhanced yield.
Gotcha. So Simeon, we've typically seen advisors, when times get a little bit tough, they may shift to a dividend strategy, dividend growth strategy, or higher dividend strategy, as well as look for that buffer of coupon payments from bonds. What did you see in fourth quarter in terms of advisor behavior, and how do you think that's working out?
Well, we definitely saw advisors starting to take a closer look and saw assets flowing towards dividend growth. And if you look at the S&P 500 Dividend Aristocrats, there are a lot of ways to think about how quality manifests, but I'll just give you one that's interesting. The S&P 500 Dividend Aristocrats actually have slightly smaller margins than the S&P 500, but dramatically higher returns on capital. So they use their balance sheets really efficiently.
Okay.
If you're worried a little bit about a downturn, wouldn't you want a company who can tolerate a little bit of degradation of top line and margin? And that came through very well in the performance. The Aristocrats substantially protected you and outperformed the S&P 500 in the sell-off. So that was a great combination. If you put that together with S&P 500 bond, those are high-quality investment-grade companies, and there was enough coupon income in the fourth quarter to offset just a small degradation in price such that you were almost flat in the S&P 500 bond index. So the combination was very effective in protecting in tough times, but also we think could be a good opportunity to generate some participation going forward as well.
Yeah, flat certainly helps you when the S&P 500 is down 14%
Exactly.
for the quarter. So, Jason, another aspect of quality might be the idea of credit ratings. So if we were looking within the S&P 500 bonds, how does that index compare to the broader, what I would call the beta of the corporate bond marketplace?
Yeah, so I briefly mentioned earlier that the 500 bond is skewed slightly towards higher quality when you compare the credit profile of the 500 bond to the broader investment-grade corporate bond landscape. And what we've seen in the last 10 years in this low interest rate environment, there's been just significant growth in the corporate bond market. It's now over $6 trillion in size, and 54% of the market is in triple B. So you've got your triple B plus, triple B minus, and that triple B minus rung, which is the last rung on the investment grade ladder, it's 20% in the broad market.
Yeah, and I just don't think advisors know that. I think they think of the space as being more homogenized than skewed towards that low end of the credit.
Yeah, and there's some risk there. So the main risk being potential downgrades in that space. These bonds would move from investment grade to high yield. If that's the case, you've got some large institutions that would probably be forced to sell. Your insurance general accounts, your pension funds, they have constraints with how much high yield they can hold. So
Right.
there could be some forced selling. The second risk is some spread widening in this space. So as Simeon alluded to, in the fourth quarter, there was some spread widening, and you're going to get more so in that lower tier of BBB minus.
Yeah.
And when we compare the S&P 500 bond index to that broader market, there's about 7% less exposure in that BBB minus rung.
Yeah. So Simeon, just to end with a question for you, we did see the market move down quite a bit, the equity market in the fourth quarter of last year. Wondering what you're seeing, like as we're looking into 2019, what are you seeing as you think about this construct of combining Dividend Aristocrats and 500 bonds? How does that look to you?
Well, it seems like a good bet to think that earnings growth will slow in 2019. We've had superlative earnings growth for several years now, and the odds that that's going to slow down a bit are extremely high. If you look at the S&P 500 Dividend Aristocrats, just think about the rule set. 25 years of increasing dividends. Guess
Right.
what that means? That means these are companies that actually increased their dividend through the financial crisis.
Right.
So no one's certainly thinking that a financial crisis is in the cards, but in an environment where earnings growth overall slows, the odds that a dividend growth set of companies like the S&P 500 Dividend Aristocrats can outperform the broader market are a pretty good reasonable thought.
Yeah, that makes sense. Well, gentlemen, thank you so much for your thoughts on Dividend Aristocrats and 500 bonds.
Thanks for having us.
If you want to learn more about how indexing works for income and diversification, please visit our website at spdgi.com. Thanks and have a great day.